You guys can give me an audio check. I'm checking Twitter. Just give me a 5x5 that you should be seeing the risk disclaimer and my audio should be good. I apologize. Stupid thing wouldn't connect. Thank you, thank you, thank you. We are looking at... Not yet, we're not. Hold on. All right, so we should be seeing the ES chart. All right, so I walked you through on Twitter because I felt we would see the movement ahead of the opening at 9:30. We're still inside this large consolidation. We have this week's new week opening gap and the consequent encouragement of that level. Previous new week opening gap, it's up here. Traded through rejection block here. Failure. Broke down below short-term low. We have new day opening gap, which is here. New day opening gap. Thank you for making that trend this morning, by the way. NDOG and NWOG was trending on Twitter, which I thought was kind of cool. I almost missed it because I usually don't look at those types of things. But the new day opening gap is the closing price at 5 p.m. and the opening price at 6 p.m. New York local time. So there may be a gap. There may be no separation between bodies or wicks. Either way, you want to have the difference between those two price points and extend that out through the time of the trading day, because the algorithm will reprice back to it multiple times. As you can see, it does here, works around in the level here, touches it here, the high end, then moves away from it. So then we drew down into the new week opening gap from previous week, and consequent encouragement through it. I gave you 41.13 as a draw on liquidity, which would be below that right there. That's what I was using, that low. So now what I'm looking for, because we came all the way down to new week opening gap, consequent encouragement, which is the midpoint between the open and close, respectively, for Friday's close and Sunday's opening price. I am preparing a lecture so that way you guys know what it is that you're doing with these specific areas in price action, because they're algorithmic. Okay, and I think just a few days working with them since last week when I first introduced it to the trading community, and no, my charter members don't even know anything about it. They learned it just like you did. Okay, so a charter member is someone that's been with me for a long time through my private group that I no longer host for new members. There is no future upsell, so please stop listening to people drone on about how I'm making you get all worked up for a future sale. I'm not. In here, watch this area here. So 41.17 1/4. It's reasonable to expect if it's going to bounce a little bit in here. That's a reasonable price level to see it want to retrace back up into. Not that it needs to, but it would be permissible in my eyes. All right, this dropped down to a 5. And whenever there's that's yesterday's new day opening gap. Went right up into a fair value gap between this candle's low and that candle's high. Beautiful delivery there. Take that off. So since we've made our way all the way down to new week opening gap, the argument that I like to wrestle with when it does something like this is, my internal dialogue is, are we looking to go below it? Because we've already explored price above it and the previous new week opening gap. And we have repriced significantly lower from that being last week's new week opening gap. That's this level here to here, and the dotted line here is the consequent encouragement or midpoint. And this week's new week opening gap and its respective midpoint or consequent encouragement. So what I'm looking at is, do we have the interest to see it delve below 4099.5? We've already went up into this fair value gap here. Reprice into consequent encouragement. Sell sides below here. So I would want to see it animate, large range candles on the downside, trade into like 40.98 and see what we get once it trades there. Everybody thinks that it's an easy jump on, get short because of what we've already seen pre-market before 9:30. And it's all on the heels of the news embargo lifting at 8:30. I was prompting you to be aware of on Twitter. Now, if you look at where we are right now, price-wise, it's 4,100. And regular trading hours, this is the gap between yesterday's trading up here and down here. So what I'm watching now is what we do once we go. Now we're below the new week opening gap. Typically, what will happen is it'll accumulate here, run back up, and start to work inside this gap. So I'm looking for that type of event in here. Not that I'm seeing it here. I'm looking for that type of signature. Like I was explaining yesterday, I was outlining the lows, how they were suspect, and I was looking at SMT divergence, and I taught you real time the dollar index failing to make a higher high, while ES was making that lower low, NASDAQ was making the lower low, and Dow was making lower low. And I called that turning point. I gave you a very specific, we weren't not lost in price action yesterday. Goobers. We were specifically aiming at that breaker. I was teaching you how to use it, how to frame it, how the candles would respect it. The wicks are allowed to trade outside of it. That's fine. So now think about what we've seen here. The session has opened up. This is all electronic trading so far from the 9:30 opening. Short sellers have sold. And where's their stop loss at? Right here. Right above here. So generally, the chase price, when it's a big move like this down, it's quick to punish those individuals that do that. And you see traders that are real quick to trade in the first couple minutes of trading. I am not a fan of that. I don't like that, because this is the usual procedure that takes place. Retail sees it. They say, oh, wow, it's really down so far. Let's go short. So when they go short, the traders that do use a stop are going to do what? They're going to put it right at the highest high that's printing on their charts, which is right here. So what you want to do is, on your chart with TradingView or otherwise, you want to use the high that's formed on the opening range that's formed thus far up to the closing price, and you want to extend that to the right. And you want to use something that's more friendly on the eye, because this is a little too much. Okay, so what I'm looking at when I do that, when I drop back into electronic trading, I have that range on my chart for you to see it. So that means all of that could be potentially challenged intraday, digging up into that. I'm not suggesting we're going to go all the way back up there, but at least for the morning session, trading the opening range, which is the first 30 minutes of trading after 9:30, so 9:30 to 10, And there's the buy stop getting tripped on retail after taking out our new week opening gap low down here. So does that sound like we're lost in price action? We're lost in love, okay? We know what we're looking for. So anyway, all through here, we want to see, does price want to go above that? Does it want to explore all of that opening range gap? Because that's what we're referring to this as. When we see a gap at 930, the opening range gap is the difference between yesterday's trading close to 930's opening price. So opening range gap, for your notes, that's what we're referring to here. That is not new day opening gap. That's not new week opening gap. So now we have this candle here. You want to be watching this. If we have a willingness to want to go above it, that's a breaker. Because we have tongue twister. Because we have this low here, and then a lower low that we went through on our new week opening gaps low. We went down below it. Now we traded back above where I told you the retail buy stops would be. Did you see a depth of market chart shown here? Did I reference any of that? No. We're looking at what the chart's going to tell you. The simple open, high, low, and close. There's no necessity for anything extra. Anything I'm drawing on my chart is just to draw your attention to specific areas in price. That's the only thing I'm annotating for the purpose of that only. I don't have this stuff on my chart, but to articulate what it is I'm referring to, I have to draw these things out so that way it gives you conceptually a visual on where price should return, how it needs to consider other previous ranges, something to that effect. But because we have moved so far from yesterday's close, and now we're opening where we are now, the opening range gap, when it's this big, it makes the very first half an hour, 45 minutes very tricky. So I treat it much like when we have a big range day, like say we have a afternoon session run that just explodes, and whether it's going up or down, that matters not. But if there's a big range, a very large range day yesterday, the morning session can be tricky. It can be choppy. It can go back and forth. Take out buy side, take out sell side, take out buy side, take out sell side. And then later on, when's that? It could be right before lunch in New York time, around 11 o'clock or thereabouts. Then it'll start a run that generally goes under the radar of most retail traders. They don't see it when it starts. And then the afternoon will be a better trading opportunity. So what I like to do is I sacrifice this morning session and I lean heavily on the 1:30 to 4 o'clock time period in the day, because if it's going to trade back up inside of this shaded area here that I have in gray, that's a lot of range. I'm not making the case it's going to go all the way back up there, at least not right away. But it's something that the market will likely want to consider revisiting, unless, now this is the only way it would be negated, if we just crashed. I'm not saying we're crashing, but I'm saying if it were to just completely fall out of bed and just find no traction at all and just want to go lower, then this type of range that's shaded in gray would just not even be considered. It would just be a breakaway gap. So we want to look at this fair value gap here. That's the next premium level. It's a little too much, Michael. Okay, so we came back down to consequent encroachment of the new week opening gap, which also is a order block with a fair value gap. So we want to see, does it have the willingness to want to go above this short-term high? If it does, watch and see how we react inside this fair value gap. If we were to trade up through it and act as support, that would take us back up into the previous week's new week opening gap low. We would aim for something like that. You should not be pressing the button this morning. Some of you already went nuts and got drunk on Twitter this morning based on what I shared. Touching the new week opening gap high. So I'm going to take this shaded area off. You understand on your charts, this is what you should have as a visual reference to the difference between where we were yesterday at close and opening today. Okay, so I'm going to take that off so that way it doesn't distract me. Too many things to be looking at. Disorient me. So already, right away, you can see the first 20 minutes or so, it's doing what? Aimless, listless trading. The only thing it's done so far is the two things I told you it would do. Go down, sweep the new week opening gap low, revert back to what? The buy stops above the intraday high, because traders are doing what? They're seeing that it's gapped down. So right away, they're fearful they're going to miss something, right? I'm afraid, I've got to get in here and do something. And they plunge headlong into the marketplace trying to be short. So they use their due diligence. They want to protect their position, right? They read all the books. They're short and they put their stop loss in a protective capacity in the form of a buy stop above this high. It gravitated right to that, like I mentioned. We went back down to consequent encroachment, new week opening gap, the new week opening gap's high. And now we're showing the bodies respecting that breaker again. That signature is what you want to see, and we've already seen it try to make an attempt. I want to see it go through this high here. I'm not interested in the 41.13 level anymore. It's already done its job now, so I'll take that off the chart. That was your draw on liquidity for pre-market. So think of that pink area up here as like a magnet, okay? And price, every new tick in price that moves up and down, imagine those being paper clips, okay? And the magnet is sitting right here in this shaded area. So if you throw a whole bunch of paper clips at a desk where a magnet's sitting, where's the paper clips going to go? They're going to cluster around the magnet or within its magnetic field. And that's the analogy I like to use when I'm teaching my sons or new students. Much like everything else I've used, I have 1,000 analogies, I know. It's the teacher in me, I can't help myself. But it makes a lot of sense that, if you were watching every new tick fall into the marketplace, okay, every time there's a new tick in price, where price is going is your number one goal right now as a new student. Or if you're a trader that's struggling break even or never made profit because you don't know where price is likely to go and you can't figure it out, you can't ascertain a consistent approach to reading price, which lends well to analysis and trade setups and entry and targets and stops. Before you get into all those details, which is where you think you should be at right now, you need to understand what makes price go where it should go next. It's one thing to talk about it after the fact and look smart, that's fine. You need it and you're learning. Hindsight's essential for the very first steps in understanding anything. But you have to have one primary skill set in the beginning that sets the stage for your continued growth. And that is the understanding and learning of where price should go. Notice I'm saying should. It is not a definite it's going to actually happen all the time, because if I was 100% accurate, I wouldn't trade with a stop loss. I would do full margin, no stops, and just go for broke, right? But because that's impossible, it's not realistic to expect that. And there's always this looming potential for a manual intervention where things can just simply go upside down, a black swan event, something that you don't foresee coming out of left field, and then boom, the market just does something you and everybody else wasn't expecting, and that can harm you. So while we have to respect that measure of underlying risk that's always there in any measure of speculation, whether it be forex, stocks, crypto, or futures here, it should not be paralyzing. There are times when the market just isn't going to be the end of the world, and you can take opportunities and engage them. All right, now look at what we've seen so far. Okay, this is what I'm referring to as being mentored for real, not just reading a book or watching somebody on YouTube, whether it be me or someone else. Understanding why the market will be difficult, when will it be easier, when should you trade before the 9:30 session, when should you wait for the 9:30 session. That's being mentored. I'm teaching you that. I'm literally walking you through it live every day, whether it be Twitter before I started doing live streams last Tuesday, and now I'm doing it both. So I'm giving you a complete immersion in what it's like to be properly mentored. We have buy side resting above here. So if it's going to run through that, what would be reasonable for a reach above this area here? Let me draw a line on it so you can see it visually, because you're used to seeing that anyway. Lost in price action. Get the hell out of here. All right, so we have buy side. So for folks that have trailed their stop loss, that's short. Give me 1 second. I gotta make this line obsessive. I'm sorry. So we have buy side here. So what's occurring and why that's even being referred to is the market has dropped pre-market, which we were looking for. We called all that on Twitter. The movement here is a consolidation, and once it started breaking lower, everyone that was fortunate enough to be short, they have rushed their stop loss right above these relative equal highs because they see this as what? Retail sees that as resistance. So they're going to jam their protective buy stop on their short positions, hoping that it goes to Hades today. And because their stop loss is sitting here, and I explained to you where the retail will be placing their stop here, for those that just watch the opening value and see that it's on CNBC saying it's really down today, blah, blah, blah. So retail's going to do what? They're going to chase and dogpile in on doing what? Short. They want to chase it going lower. So because I'm teaching you, because we had a big event before 9:30, before the opening session at 9:30 and the ringing of the opening bell in the stock market, that sets the stage for what you're seeing here. Choppy, listless price action. It denies them immediate continuation on the downside, and it runs against those individuals that have already been profitable and still hold a position in the marketplace. So open float is the liquidity resting above here, and the imbalance in here, that's not liquidity, that is going to be engineered liquidity later on. So this is inefficiency. So you have two things here lending for why it should, if it's not going to go lower, and if it doesn't stay in a small range like we see here, where is the money? The money is trailed above the recent highs, which we've seen it run here, with that run here, here, and here. What I'm watching is it was interesting to see it not get above these right here with this little spike up. And we're just hanging around inside that breaker still. So when I'm teaching you like this, I'm telling you where the market's going to be problematic, when it's going to be choppy, when it's going to be range bound. And none of the books I've ever purchased, none of the courses I ever looked at, purchased, was shared with me. All of those things that are available out there, they never really adequately talked about how to avoid these problem areas. They just made excuses for, well, sometimes it's just random price action. It's not random. You can predict when these things are going to occur, which is what you want to learn how to do, because you will learn that these are the very conditions that you blow your account in. You'll get frustrated. You think everything's a turning point. Oh, I was wrong there. Now it's turning the other direction. Oh, I got wrong there too. I mean, reverse, it's going the other direction. And before you know it, you got 70 trades on for the day. You've blown your account. The commissions end up taking you to a point where you have literally nothing to even start with the next day. And you feel demoralized simply because you don't know how to identify where the market's going to be very, very uncooperative. Touching the new week opening gap high again. For those of you that don't follow me on Twitter, the satisfaction of everyone that was following me on Twitter this morning, we don't need any further movement today. We've already seen it pre-market through the tweets and identification of the 4113 sell side liquidity pool I tweeted this morning. So it's important that you have both. Twitter is my real-time connection to you. Whether you like to be driven nuts all night long while you're sleeping or not, I'm going to tweet. Okay, I'm going to tweet when I have something to say. So usually it's going to be beneficial for you to have that on or alerts on before 7 a.m. New York local time. Now, I don't have the fellas that I like to listen to and the young lady I like listening to that live streams. And no, I'm not talking about Patrick Whelan, and no, I'm not talking about Trades by Matt. But there's a few other live streamers I like watching, and I like reading their chat window. You know, when they have their live streams, they have everybody in the chat room part of it, and they're all screaming what they think's going to happen. And I like to look at those things when I see price action doing what I'm teaching you. If I see a heavy hand in the retail perspective using those live streamers chat rooms, not necessarily anything that the live streamer themselves are saying, but the ones that have a pretty good sizable following. Retail traders, noobs, they tend to be chatty, real chatty. And what they do is they toss their sentiment out into the abyss of the internet. And that's a wonderful asset for someone that knows how to use it, because I'm looking at that and I'm pairing that perspective of someone that's street money, that they have no idea what smart money is. They're looking at something indicator based. And when they're collectively cheering on, oh, it's going to go here, it's going to go there, it's going to go up, we're going to the moon. Whenever I see those emotionally charged statements, and it's almost like they know, it's almost like they absolutely know it's going to go there. When I see that, and I'm looking at a fair value gap or a PD array or a draw on liquidity that would be opposed to that, it's almost like a lead pipe sense trade. It's almost a guarantee that I'm going to be right. And it's not to be viewed as arrogant. Please don't read into what I just said as arrogance. It's just the way things are. It really is just like that. When someone that's new gets involved in this market or any market, it's a mirror. And if they talk out loud, they're going to share their inside view of what they want to see. They think they're manifesting it. Like, I'm going to manifest my wants and desires, and the universe is going to bend to my will and give it to them. It doesn't work like that. But we can use those things, those sentiment readings, those gauges of sentiment through the lens of a neophyte trader by having these lives. I love the fact that live streamers live stream. I love it. I have 5 of them that I use as a wonderful sentiment gauge. Their chat window is the best overbought, oversold indicator you'd ever have. And I don't need to have it plotted on my chart. I just got to just scroll through, toggle through my windows on my browsers and see, okay, where are they at right now? Because if I see something that I think is pretty much a good idea, I'm going to go over there and see what are they thinking. And if it's 100% diametrically opposed to what I'm thinking, it's done. I'm in there. I'm in full margin. I'm in it as far as I can push it. I'm going to do it. And that might sound mean, it might sound arrogant. It's not meant to be that way, but that's essentially what you're doing when you're using overbought, oversold indicators. You're trying to weigh the sentiment of people that follow indicators, right? So I don't have any moral dilemma with that. You can hate me for it if you want, but it's not against the YouTubers themselves. It's the wonderful medium they provide by allowing folks to share their sentiment. So we went back down inside of this fair value gap, touched the consequent encouragement of the new week opening gap. Still listless, still range bound. Nothing stands out as obvious. Nothing's a clear trade. Nothing here that gets me excited about wanting to do anything. We're not lost in price action. We're just waiting for an obvious tip of the hand by the marketplace. And right now, it's just chopping people up. Everything that looks like a trade, they're going to second guess it every time it retraces back to the middle. Middle of what? ICT. The low that's formed here and the high here. It's just gravitating back and forth, back and forth. And it's working the upper boundary of the new week opening gap. So if it were to take out the low of the new week opening gap, which is here and below this low with acceleration on the downside, then we might need to go into the 40.89s. But I would have rather seen it take out the buy side before it would do something like that. There's going to be lots of small little fluctuations and movements in these live streams that I'm not interested in. But if you see them as a setup, if you see them that it resonates with you based on the things I've taught, or that you understand about your own exploration and reading the tape real time, don't let me or anyone else discourage you in that pursuit, because I allowed that to happen in my own trading when I was a 20-year-old. I had it figured out earlier than I realized, but I kept tinkering with it. I kept adding things and taking things away and changing things and putting more emphasis on silly things that had nothing to do with what price was doing. So I think right now, if you were to look at what we've seen essentially 33 minutes of trading since 9:30's opening. Sitting with someone that can tell you when it's going to be like this, doesn't it feel empowering? Doesn't it feel empowering to know that you can predict when it's going to be harder than it needs to be for you to push the button? If you're going into the marketplace and you're looking for opportunity and you want these opportunities to present themselves where they run away real quick from your entry and quickly jump to your targets, that's what every trader wants. But unfortunately, most of the time, because you're looking at books or you're chasing the excitement or fear of missing out, FOMO, you see the movement in price actions that you weren't a participant in. And you think to yourself, I got to get something of that. I may not have been in the entirety of the move, but I got to get in there and say, yeah, I had some of that, because I can feel like I'm part of the clique on social media when they all say they had it, but they didn't call it beforehand. Okay, that fear of missing out is conquered. It's defeated when you understand when there's times when you shouldn't be doing anything and you're not going to ever second guess it. That's empowerment. That's maturity as a developing student. That's one of the hardest things to overcome as a new trader in development, is keeping up with everybody else on social media. That's not necessary. In fact, it's a problem. Keeping up with the Joneses is an expression we have in the US. And you certainly don't want to be trying to do that as a trader. You shouldn't be trying to keep up with me. You shouldn't be trying to keep up with someone else. And you shouldn't be trying to compare and contrast your results with someone else's, because you don't know where you're going. And you may be looking at someone that has already peaked in their learning and their aptitude. Their skill set may have arrived at the highest point, and you see them in relationship to your present understanding about what it is that you see in price. And you may look at that as, I'm not as good as them. And you defeat yourself mentally when you're really designed to be far better than them eventually. So you should never look at someone and grade your prowess or understanding in relationship to them. I didn't do that. I never wanted to be a part of that type of thinking. I've always adopted the mindset that there's nobody that's going to be able to do this better than me. And I just got to give myself the time inside the cocoon where nobody knows me, and then I'll come out and show the world. Do you like my colors? Do you like my wings? I'm being funny, that's all. It's not funny, I see too. So here we are, meandering around. We went back up and touched that breaker. I want to see it erode all the way through this and get back on the upside of it. Not because I want to be right, not because I want to take a trade, is I want to see it move away from the consequent encroachment of the new week opening gap. I would love to hear the internal dialogue of those individuals that have tried pushing the button and yet got stopped out or scared and went the other direction all through these first 36 minutes of trading. And here you are, calm, cool, and collected, not worrying about nothing, just chilling, observing, reaping the benefits of new experience, understanding why you should do something, why you shouldn't do something. There's no impulsive tendencies because you have anything risked. There's no monetary attachment to this. You're reading price and you're actually growing better as a trader right now, but you just don't have a measurement to compare it to. A month from now, you're going to see how much you've improved. 3 months from now, you're going to feel like a totally different person. Right now, it just feels like, oh, this guy's not talking about a trade, man. Get on with it. Let me go watch so-and-so, Pip Slayer. Let me go watch Market Maven, The Market Murderer, The Market Marauders, all these YouTubers out there. I don't even know if there's somebody that has those names. Just know that I'm just pulling names out of the air. I'm not trying to name anybody or name drop, but they want to chase somebody to mimic and take trades on. I want you to know when to do something, when not to do something. But when you know when you want to do it, it's more likely to see it deliver in price. And it's immediate gratification, not, man, I hope it goes here. Let me go into the chat rooms on this guy's live stream. Hey, does anybody think it's going to go here? Do you think it's a good long? If you're asking what anybody else is thinking about your trade, it's not your trade. That's why I don't like to comment on other people's trades, because I'm not going to manage it for you. And don't make your trades known publicly. Don't do that, because you're inviting feedback that you really don't want. All it's going to do is confuse you, second guess your analysis. You don't believe me? Ask my students that can be profitable. And then when I talk about what I like, it scares them out of their trade. And when they get out or collapse it or do something entirely different, their trade would have panned out and they're cussing me. We're both right, but they get shaken out of their trade because of their respect for me. And that's why I'm telling you repeatedly in these live streams and in tweets and in Twitter spaces when I'm doing those rants and such. Don't let me influence an idea that you have co-signed. Whether it's fruitful and comes to fruition, or if it fails on you, you're going to learn from that. You're going to learn from your failures. So just let it happen. And you want to be watching price when it's like this. This is how you identify what it's like when you don't want to be in the trade. This is what you get chopped up in. Nobody writes books about this. Nobody makes video courses or chapters in their mentorships that cover this, because they have no idea what the hell they're doing. That's just the way to nail it down in the most simplest terms. They don't know what they're doing. And you see them on their live streams and they're trading 16, 20, and 40 contracts in a simulator, trying to correct their drawdown to save face. And they're doing it in environments that are not conducive for high probability trading. There's a better way of doing it. All right, I like how we came down to the low end of that fair value gap. I'm sorry, why did I say fair value gap? Bullish breaker here with this low. Touch the bottom end of that shaded area. So see if we can get a lift up out of that and reprice into this buy side. The outcome, when you're learning to read the tape like this, you are not trying to impose your will. You're observing. Okay, this is what you're supposed to be taking away from this event every time you sit down with me. You don't realize it, but by watching price like this, subconsciously, you're seeing things that will be identified at a later time in future subsequent live streams where you see me talk about something that repeats, and you're like, I see something here, and then I'm going to mention it, and it's going to make you smile because you're going to, I saw that before you said it. That's growth. That's progress. But if you're here for the first couple times, and we are all here rather, for the first few times, because I only started doing live streaming last Tuesday. But you're going to feel more empowered by doing this without the outcome needing to be favorable for you. I was talking to a well-known trader that has a pretty good following this morning early on, and I mentioned how you trading in front of people, and there's the buy side liquidity, by the way. I apologize, I didn't mention as it was going on. We want to see it try to get through and maybe trade up into this area here, which is this imbalance. This to me is a little too shallow. I mean, it's effective enough to run the buy side, but I would expect to see a little bit more pronounced run higher. I'm not trying to call the higher run all day long. I'm just saying I want to see it trade up into this fair value gap. And I'll talk about why that is even useful, or why would we concern ourselves with it once it gets there. Well, there you go, we're there. Consequent encroachment, look for that, which is midpoint in here. The Bob Ross of trading. Mr. Mellow, never surprised. I'm telling you, when it gets boring, you're on the right track. If you're excited and you're all hopped up on goofballs because you're watching price and you can't wait to push the trigger, you're not ready to trade. When you're bored and you're not really interested in the outcome, that's how your trades need to be. They need to be viewed that way, where I don't care if it goes where I want it to go. I'm just following the logic. If you follow the logic repetitively and you're not swayed by emotions, you're not swayed by greed or fear, you're going to be an exceptional trader. You're going to be so formidable. You're going to be able to find things that the average trader isn't going to be able to. And it's going to feel amazing when you look around and you see what everybody else is doing. They may be profitable, but you're going to be doing things that are light years ahead of everyone else. And it's an enriching experience as a trader. You just feel dialed in. And there's no way really to articulate it except for you have to experience that. And some of you have already experienced it by looking at the things that I've been teaching the last few days. You're seeing it in your own chart, and that epiphany, that moment of aha, wow, where the veil is pulled back just a little bit and you take a peek on the other side and you think, these things are not random. These markets are not random. And you can predict them. You can see them. You can anticipate them. So anyway, I was talking to a trader that's pretty well known and I have respect for it. And they were sharing their concerns about feedback that they receive and such. And one of the things I mentioned to them, and I've mentioned it very publicly to you all as well, the tape reading like this in front of you without a safety net, I don't have any problems with this because I've already warned extensively not to take it as trade signals, because it's not. Nobody can, I mean, the feds could be sitting here listening. Nothing in here said buy here, sell here, put your stop here, try to make this much money. We're watching candlesticks paint. That's it. That's all we're doing. That's how I did my mentorship. It's all price action. You're learning how to read price action. It's not trade signals. There's no risk of losing anything. There's no hope to make any profits. It's just learning how to read the chart itself. I leave the viewer, the students themselves, to decide whether or not they have found something on their own by using this information directly or indirectly. And when they choose to go into a live account setting, they've done so without me doing that or inspiring it. Not to the degree where, here, go with this broker or use this, this particular broker to trade with. I don't do that. So it's always paper trading and demo, and it relieves me of any financial responsibility. Zero. I have none. Because if you go into a trade and you lose money, you've done that to yourself. It matters not what you've heard me teach in the past. I didn't tell you to get in that trade. And I have a lot of respect for people that trade publicly. Look at the bodies respecting the low of the fair value gap. Now we're back down into this bullish breaker. If we lose it now, if we trade below it, because we have gone up into an area that had my interest this morning, this to me, this running up here into this area here, is much more meaningful. And it is, in some ways, allowing for, if it were to break below this breaker and act as resistance, then we could explore lower lows. But notice when I was giving you the commentary earlier, I would have favored this here, running a buy side and going into this area here, because what would be the mechanics behind that and why it is noteworthy for me. And don't worry, I'll come back to the conversation I was having a moment ago. The buy stops here. If the market trades there and goes up in this area here, we're at a short-term premium. So if we were to lose this bullish breaker, which is shaded here, and trade down below it and act as resistance, that becomes a potential catalyst for lower prices on the day. But notice that it had to trade to a premium. And I'm not saying it's going to go down here, but to me, it would be worthwhile to see this very thing happening here versus just opening at 9:30 and just cascading lower. You follow what I'm saying? Meaning that everyone else just wanted to go short right from Jump Street right at 9:30. And at 9:30, they gave them that little cookie, made them feel like they're on the right side of the marketplace, and allowing them to put buy stops here. Also, anyone that didn't trail their stop loss here while being short early on, now they have their stop here and here. So there's two pools of liquidity with an imbalance shaded in this area here. So if it were to go lower, okay, it would be better for you to wait. If you were trying to go short or looking for a reason to be short, it would be better for you to wait for buy side to be taken out, like it's been done here, and trade up in this inefficiency, and then judge what price is done after that. Has it sold off since it hit that? Yes. Did the breaker respect it? Or I'm sorry, did the price respect that breaker? It has. We're back inside that fair value gap that's shaded in pink. So we would not want to see it show, support in this. It's the PD array, which is the breaker itself, this candle here. It's not simply this old high, draw a line out, resistance broken, turn support. We're looking at how does it react when it gets there, and you're constantly weighing that. Does price respect these PD arrays? And since it's respecting it, you don't want to hold on to the idea, okay, now if you were thinking about going short, my method teaches you'd have to see that breaker be broken and then come back up to it and act as what? Then resistance. You can't just simply say, oh, we have a fair value gap, let's go short here and expect it to run out these relative equal lows. There's a logic that's being taught to you. You have to see certain things to qualify whether or not something should be there. And we have such a large gap from yesterday's close to where we opened this morning. This entire fair value gap, we were at now consequent encroachment of that. It should expand up into the high end of it. And if we run through it, come back down and touch that support, it may act as a catalyst or springboard to take us up into closing in the small little remaining balance of this fair value gap and then up into here, which would be what? The previous week's new week opening gap low. And it would be digging up into the difference between Friday's closing price and where we opened at 9:30. So the other trader I was telling you about, that he calls the market. He's out there. He's showing people, what he's doing with his money and how he's risking it and such. And I have a lot of respect for that. And anybody else that's live streaming too, that pushes the button. There we pierce through that fair value gap. So now you want to watch. Does it feel like we're lost in price? I'm just curious. Lost. So we have that tiny little remaining portion there. And yes, we've already talked about how one tick is enough. That I'd like to see it run through that pretty quickly, not just tap it. But then we turn back to the old previous week's new week opening gap low. And I'm unfortunately having a lot of things on my chart, but I saw somebody posting on Twitter. They said, I have too many damn lines on my chart now. You have to do your workspace management a little bit better. One chart, and unfortunately because I'm presenting to you and I'm kind of coaching you through price action, I have to show you where my new week opening gaps are that I feel are pertinent to price right now. But you should not be trying to operate and do all your other analysis and lipsticks like the fair value gap I have here and all, the breaker. It's too much. Your eye will not see the things you need to see if you're putting it all in there. You can't have a kitchen sink approach just because I have it in my repertoire, in my arsenal, and now you're adopting it as well as a weapon for you. It doesn't mean throw it on a chart. Have a chart that you refer to with just new day opening gaps, new week opening gaps. That's a separate chart that just shows those only. No other annotations. None. So that way it allows you to toggle through when price is moving around. It allows you to take your attention away from, well, what we have here. I have the bullish breaker, the buy side liquidity pool relative equal highs, and the SIBI here in the form of this fair value gap and its consequent encroachment. So that's a whole lot of lipstick with this new week opening gap too. So while you're looking at price, it's like looking at cars going by on a street. It's hard to focus. There's always something to draw your attention somewhere else. So if you're going to be referring to a conceptual idea that I've taught you, and it may be something else outside of what I teach too that you like to still use, I don't know what that would be, but whatever it is, you want to have a chart or a template in your platform that you call on just for that purpose. So your chart remains naked, but only provide you that visual point of reference that you're looking for, like new week opening gaps and new day opening gaps. So you don't want to have too many things on your chart. But unfortunately, to prevent myself from losing track of where I am and doing something and not talk about the right chart, which is what I've done one time already in a previous live stream, I'm learning how to do this. I don't claim to be a good streamer or a good YouTuber. So I'm trying to do my best to get better at it so that way I'm more helpful to you. But because I'm still in my early stages of learning how to do this efficiently as a streamer, unfortunately my chart's going to have a little bit more lipstick and more things on it than you should. So don't look at this chart thinking, oh, I should have my chart look like that. No. And once I have an idea where I see the breaker is, again, I don't have that on my chart. Like it's not there on mine. It's here for you to learn from it. See, I can see that low, that high, that lower low. My eye goes right to that. And that candle here, I look at the range, I know the prices, and I write those prices down on a little yellow notepad next to my screens. And I'm referring more to that piece of paper that has my levels on it than I am on a chart with annotations. I'm a numbers guy, not this visual, artistic flair. It's only for your benefit because most of you need it conceptually shown to you on a chart. So let's take a look at what we've covered so far this morning, and then I'll come back and close my discussion about the other trader I was telling you about. So we opened up at 9:30 with a large gap lower. We saw price trade from that opening gap here, small little rally up, drop down into new week opening gap low, setting the stage for buy side to be placed above the short-term high. And then we also see these relative equal highs. So wherever there's a market area that is too smooth, okay, that means lows are relatively the same or highs are relatively the same. That looks like a ceiling, okay? Whenever that's like that, that smooth edge is likely to be made jagged. That means it's going to tear through that, upset that smoothness. We've seen that here. The market came down into our bullish breaker. I mentioned that if it were to go lower, it would need to go through the breaker, come back up and act as resistance. Did it do that? No. It respected the breaker. So now price goes higher. What actually happens after that? This down close candle that trades into the bullish breaker does what? Becomes a bullish order block. That candle's high, 41.14 and a quarter, becomes the low of this candle here, 41.14 and a quarter. So what we're seeing is a bullish breaker supports price, it repels it. Yes. Does this down close candle support price here? Yes. We dig up and through, which is why I said I want to see it trade to the upper end of this pink shaded area. That in itself, from here to the top of that fair value gap there, that's a 5-handle run, just with the logic I showed you there. That's a trade idea. That's a setup that could have been utilized for you as a engagement. Go back into your own charts and log that as an example of watching where it delivers there. I mean, I walked you through it real time when it was there. But this also, this trade down here, when we turn back to the breaker, see, this is what you're familiar with. This is how I teach it on my YouTube channel. Here's the breaker. It needs to leave it and then come back down into it. That's your classic ICT bullish breaker entry. That's a setup. That's a setup. Targeting is consequent encroachment in the high end of the fair value gap. Where's their 5 handles and all that? That's for you to determine. And look for that going forward. If it doesn't make any sense to you, for those that are trying to figure out what we're doing here, what's the purpose of all this, you're going to find your own setup. You're going to see it repeat. You're going to see me talk about things that confirm your observations. I may not say in verbatim what you're seeing or expecting in price action, but I'll give you a 30-year experience perspective on something that you have been expecting more insight on, or a confirmation by me. If I see it, if I talk about it real time and you see it, and then all of a sudden now that epiphany happens. You've been confirmed. The thing you're looking for has been now qualified. It's valid. So therefore now you get the confidence to go forward and look for it continuously forming. That becomes your model. I didn't push you into that. I didn't write a chapter in a book or make a particular video series that made you only trade that model. You discovered it organically being here over time, reading real-time price action. That's the best way to learn. It doesn't feel like that if you're new. It feels like we're wasting time, right? You're not wasting any time. You're learning how to engage, decipher, read price action. What is it likely to do next? Where should it go? If you can't see that, you can't see the benefit of, I mean, I'm walking you through every individual candle here. It's on a 1-minute chart. What happens if this is a 15-minute chart? It's a whole lot more handles, isn't it? So I give you the 1-minute perspective to prove that even the folks that say, oh, your live stream's got a 30-second delay or 20-second delay, implying that I'm doing something surreptitiously. I'm talking nonstop. There's no other way for me to say something else in another separate live stream. There's no way for me to keep you from receiving what I broadcast on this live stream. If I said it and my mic is on, you're hearing everything I'm saying. There's no alternative view. If I say I think it's going to go here, it's either going there or it doesn't go there. It needs to respect this level and start going here. If it doesn't do that, then there's no algorithm. It's plain, right? Simple. So anyway, we talked about how that trailed stop loss idea on shorts here and here would be the target after it traded down into here. When it was trading right here, I said we want to watch and see. Now, because we hit our objective, the levels I've taught you, which is the new week opening gap, the algorithm reprices down there, just like I talked about yesterday. When we were not lost in price action, I told you we swept the lows. Now we're going to take it up to the buy side. There was no changing of gears. There was no another different view. It was we were going higher. I gave you that again right here on a 1 minute basis. Told you it was going to go here, and then I'd like to see it sweep here, and then go up into this fair value gap. Did your chart print that? I mean, we're still here live right now. Did your chart do that? I'm quite certain that your chart, no matter what broker you use, shows that same thing unfolding on your charts live. You see it. You've handled it now. There's several 5-handle and now forming potentially a 10-handle run that you've sat here with me. I've given you all of the things that you would look for, but you're talking too much. Go back and show me what's going on right now. The order block was supported here. Price ran to the top end of the fair value gap. Then we traded back down to what? The low end of this SIBI. So this candle's high, 41.16 even. We trade down to that and one tick lower, which is 41.15.75, one tick lower. Remember what I taught you about the wicks? That's where the damage is done. The bodies of the candles are going to be telling you the narrative, the story. We trade back down, dig into what? The low end of the fair value gap, which is this candle specifically right here. Okay, this down close candle. These two consecutive down close candles, while this was a bullish order block here, when there's two of them consecutively, if we trade away from it, you have to refer to that as the order block as well. It's all one consecutive change in the state of delivery. Meaning what? That opening price is going to be highly sensitive if we are bullish. The market trades down to it here, and it's coupled with what? The low of the fair value gap that I drew your attention to well before it even formed, or not formed, but before it was drawn up into. So this is in itself what? What is this? It's three things. This low trading to this is a low on a fair value gap, while order flow is bullish. It's also an order block, a bullish order block, and it's a mitigation block. What is that? Well, it's the opposite of a breaker. A breaker is where you have a low, high, lower low. And when price comes back down into it, it's typically going to support price to send it higher. A mitigation block is where you have a low, high, a higher low, and when it trades back down into that, it'll support price as well, if your narrative is correct. If you're assuming price is bullish, and every other previous thing we've shown here, all these signatures are qualifying what? Bullish order flow. So from here to this high here, that run, 5 handles from a discount to external range liquidity, which would be buy side liquidity right here. Think of this high being the same thing I outlined over here. Someone went short here. I don't care to know how many contracts they are holding. I don't care who it is. If the market dropped, someone chased it. So they're going to place a stop loss above that in the form of what? Buy stops. So you can look at this as an ideal entry as a short-term trader intraday, scalping. You could be a buyer here, and your limit order would be right at that candle's high. As soon as it went through it here, you would have taken profit. Much in the same way, you could be a buyer down here. As soon as this candle hits it, it's scary because you haven't done it before. It's scary because you don't know how to read this stuff live, but you're seeing it can be done. No scared fearing of doing it wrong. You hear me stuttering because I think I'm going to be wrong? No. This is old hat to me, and it will be old hat to you too. And these are hard conditions. I can't wait until this market loosens up a little more. You're going to have a whole lot of fun with me this year. You're really going to miss me in November. Christmas time, you're like, all I want for Christmas is the ICT to come back in 2024. Live streaming, please. I don't know. I might stuff your stockings next year too. Depends. Might not be every day like this, but we might do one a week. So here's that next draw on liquidity we're looking for. the small little micro separation between this candle's low and that candle's high. Give me a hell yes on Twitter if you're enjoying these live streams. If this is helping you, if it's making sense to you watching it over time, real time, watching these candles paint, explaining what they should be doing next, tweet to me on Twitter, hell yeah, and that will be an encouragement to me today. That's the feedback I'm looking for today's experience. At 10:45, I'm going to close this one for today. But I'll finish what I was saying earlier about the other trader that I like and have respect for. He calls his moves and such, and he's mentioned that he's had some opinions shared in his direction, and I admitted to him that I've done that in the past. I've tried to talk about moves and specific entries and targets and stops and management and the whole business. And even when I had them right and there were favorable outcomes, invariably someone would complain that they didn't do as well as my results showed, because they don't take every trade because they want to see something qualify the trade. So let me paint the picture for you. Some of you, most of you really, want me to do a entry, a stop, a target, manage a stop, and walk you through it. Okay, I understand that. And some of you are thinking, if you would just do that for me, ICT, I could get my funded account. Well, okay, well, what happens if I did that and I choose not to do it anymore? You're going to hate me because of that, because now you have a funded account that you can't trade. You don't know how to trade. So I'll be a jerk then. So I'm always going to be used as an scapegoat for people that don't have the right mindset. So if I were to do trades in front of you, if I was to get into the trade right in front of you, put the stop loss, manage the position, the whole business, yes, it would be a sugar coma, love fest every day, and then my viewership would probably quadruple in a week because everybody would be coming here doing what I'm doing. But even in those instances, because I've done this before, there are people that are not going to do every single trade that I do. Because if I take it, there's our run into our level here. It's probably random. Don't worry about that. Remember, I said I want to see it go through that and do what? Show expansion, speed, and run quickly to 41.34 and a quarter. I'd like to see it do that before 10:45. That would be nice. But the viewership or audience members that would be watching me, they're going to be scared sometimes, because especially if I have a losing trade, which is invariably going to happen. I got one wrong last week on Twitter, and you watched me walk through it and pick it up, and it was fine. No more drawdown. But the problem with someone that's just blindly following a trader's calls or trades themselves and mimicking, they don't have the same experience to know and trust that if I have a losing trade, it doesn't bother me. It's not even a paper cut. It's just, oh, okay, well, I'll get the next one. You as a new student or a new trader, you're not thinking that. You're like, what the hell just happened? They took money out of my account. That's not supposed to happen. We're supposed to be only making money around here. And the unrealistic expectations come winding up in your brain, and you think, okay, I'm scared now. And when the next trade that I or someone else presents, you're not going to take that one because you're scared because you got hurt on the last one. And then that trade becomes a winner. And now you're behind the person you're trying to copy. The results are not the same. And other people are going to say, woohoo, look at us. We're going. We're killing it. Let's go. You know, everybody's making money. It's a party. But that one person or those that are just like that are not on that trade. So they become sour and they take their opinion publicly and they start bitching. Oh, my results are not the same thing as you. You should do this for us. You should do this for me. You shouldn't be taking any losses. Why did you hold on to the trade when you could have potentially turned around on you? You let your stock get fully stopped out and we followed you. See, I offer no opportunity for that. None. If you make money, you earn that money on your own. If you lose money, you own that. You cannot say that was a result of me at all. Nobody ever has a documentation of me telling them, here's where you buy, here's where you sell, here's your stop, take your profits here. None of that. Nope. I'm talking about candles that mean nothing. But the apt pupil will observe these things. And over time, how much time? It's going to be unique to each one of you. Watch that volume imbalance right in here. Let me draw it out long. The folks that are paying attention and are looking for things that repeat, that they'll learn to trust on their own, they're already formulating a game plan for what they want to do. And when they make the results, whether they be good or bad, I'm reminding you here that those results are yours. They're not mine. While I greatly appreciate folks that do well, get funded accounts, get withdrawals from their funded accounts or their live accounts and such, and they credit me as an influence on their learning, that's wonderful. But I am not the catalyst for that trade. You took that risk on yourself. You presented yourself openly to the market where you had no more control once you entered the trade. So the credit is yours entirely. It's all yours. And the shame and defeat and the regret is solely on you when it doesn't work. That's the number one reason why I don't do it publicly. I don't do it that way because traders that would watch me, if you're new, which is predominantly what everybody would be if they were trying to copy me, they don't have the experience to know why I'm taking the trade. And if I lose, I have the same confidence that I had after that losing trade that I do on my next trade because I know what my stuff will do for me. I have the experience of going through drawdown and coming out of it. You may not. So you're going to do what? You're going to be reluctant to take that next trade. Or you're going to wait for it to move enough in your favor to be viewed as what? Confirmation. I got a confirmation. It's moved 20 handles already. I'm trusting it now. Let's go long. Let's go ICT. Woohoo! And I'm getting out. Well, what did you do that for? I just got in. And there's people tweeting to me like that. When I'm just calling moves. I will never open myself up to that. Because as soon as I make my trade public and I know that people can copy it, the outcome now is meaningful on an emotional level. Whereas right now, as a trader, I put a trade on. I have no emotional or psychological commitment to the trade. It pans out or it doesn't. It hurts nobody but me. It only favors me. When I talk about price action openly, and I call it the tape in front of you live, you all benefit from the same experience, which is no monetary reward, no monetary loss. You're watching price paint, following a logic that I'm teaching you to look for. And everybody that does a trade based on this, you own that, both good or bad. And I told you, don't do it because you're not going to learn properly. You're going to have less of a learning experience as if you didn't do it with the trade on. I don't care if it goes up to 41.34 and a quarter right now. If I had a trade on, I still wouldn't care if it was going to go up to 41.34 and a quarter right now. I would be partialed out twice already. I'm constantly removing the necessity for the emotional attachment to a trade. And some of you that are so new have no understanding why I don't do what you want me to do, because it would make me an emotional trader then. I don't want to see any of you get hurt, ever. So I teach in a demo. But you are asking me in your infancy as a trader, and through a myopic perspective of what it is like to be a trader, you want me to go out and just show you my entries and my exits and manage all that stuff. And a lot of these people that really want it, they lace it with